Hi, Shaz Nawaz here. If you're thinking of starting up in business, one of the most important considerations, especially from a tax point of view, is to think about which structure works best for you. So let's talk through the most common and obvious structures so that you can have a better understanding. The first and immediate option for you would be to think about whether you should be a sole trader. So that's a business in your own name. The good thing about that is that all the income that comes in is yours. So you would go to a bank, give your business a name, XYZ, and you would then start running your business. And as you're a sole trader, you own that particular business. Any money that comes in, you can spend it as you please. At the end of the year, your accountant would prepare your tax return, your accounts and then your tax return, and file it with HMRC by the 31st of January the following year. Let's run through an example. Let's say you started business on the 6th of April 2018. Your financial year end would be 12 months later. In this particular example, it would be either the 31st of March or the 5th of April 2019. Your accountant then would file that tax return by the following 31st of January, which in this particular example would be the 31st of January 2020, and you have to pay the tax by that time too. So a sole trader gives you lots of flexibilities. You are the owner and you basically do as you please. That there's not that much regulation in terms of how you have to run your sole trader business. With the caveat, obviously, you have to do everything within the law and current legislation. You pay income tax and you also pay national insurance depending on how much money you earn. And just as a side note, if you earn £12,500 or less for this particular tax year, then you do not pay any tax because it's covered by your personal allowance. Moving on, if you were to set up a business with somebody else, could be your husband, could be your wife, civil partner, friend, or an associate, then you would perhaps think about going into partnership. Very similar to how a sole trader works. So there's two or more of you, you've got good flexibility. The important point to note is please make sure you have a partnership agreement. All too often I come across people who go into partnership, more often than not, husband and wife, and they don't have a partnership agreement. Why not? Because they think, what could possibly go wrong in our business relationship? And of course, the business relationship might work well, but they might fall out personally. And if that happens, then of course that's going to impact the business. And if they don't have a partnership agreement, that means when they fall out, they won't know, how to take things forward. And that happens quite often. Then they'll have to go to lawyers and solicitors, and it becomes a costly affair. And also in your partnership agreement, make sure you have an exit clause there to say if something goes wrong, how are we going to deal with it? Are we going to go to a mediator? Are we going to go to a firm of solicitors? Are we going to speak to separate accountants? How are we going to address that, and how are we going to value the business? And a partnership has a partnership tax return which gets filed with the same deadlines as your personal tax return. A partnership does not pay tax, so the individuals pay tax based on their overall income for the tax year. Moving on from that, you can then have a limited liability partnership. Works pretty similar to a normal partnership. The difference is that you have limited liability. So if anything goes wrong in your sole trader business, you are responsible. If you don't pay somebody like a creditor, they can take your house away. And if there's any money in your personal bank account, that's at jeopardy. So all your personal assets are at risk. The same risk, belongs to a partnership. Although you have joint and several liabilities, so all the partners are jointly liable, they can take your house away, they can take all your personal assets away. With a limited liability partnership, that liability, generally speaking, is ring-fenced to the partnership. So if anything goes wrong, whatever assets belong to the limited liability partnership, those are at risk. Of course, if you were found to be negligent or fraudulent yourself, then you'll have to obviously answer that particular case. But more often than not, people aren't intending to, and hopefully they aren't going to be negligent and fraudulent, because they want to run their business in a very proper manner, so that should be okay. With an LLP, it's transparent for tax purposes, so just like a partnership, the individual partners pay their tax at the end of the tax year based on their overall income. And rather than being called partners, you would be called a member or members. And you can change the profit share ratio, and it doesn't have to be in line with how much you own in the shares. So let's say there's two of you and you're friends, and you own 50% each of the business. You don't have to take out 50% each of the profits. One partner could 1 year, let's say, take 70% of the profit, and the other one takes 30%, and the following year you can change it around. Husband and wife, the rules are slightly different. I won't cover that today, but with standard partners at arm's length, you can change the profit share ratio. Moving on from that is, you could have a limited company. If you form a limited company, you would go to Companies House, as you would do, by the way, for a limited liability partnership. Choose a name, go on there, have a look on Companies House if the name's available. If it is, you can buy it. You would then register yourself as a shareholder and a director. You don't have to be a director, you could employ somebody else to be a director and employee, but generally speaking, in small businesses, the owners are shareholders and directors. A limited company is a separate legal entity. Okay, so all the money that is in a company is not yours, it belongs to the company. And small business owners, generally speaking, struggle with that concept. They think, well, it's my company, I can go in there and take money out as I please. It doesn't work like that. So the mindset you need to have is, just imagine and pretend you're working for a third-party company. So I'll use the example of, let's say you're working for Sainsbury's. You can't go in there, put your hand in the till and take money out as you please. You would be in trouble. So apply that logic to a limited company. Although it's yours, if you take money out, you either have to declare it as a salary, an income, or as a dividend, or as a bonus. So don't take money as you please, because at the end of the year, you'll have a tax problem more often than not, and you may have a overdrawn director's loan account, which I won't cover today, but I will cover at some point in the future. The company then files its own tax return, and the company then pays its own tax. So you don't pay the tax, the company pays the tax, and that's at corporation tax rates, currently at 19%, and in April 2020 coming down to 17%. If you take any money out, if it's a salary, you pay income tax. If it's a dividend, then the first £2,000, okay, is a tax-free dividend per person. Above and beyond that, then you pay dividend tax based on how much your total income is for the tax year. If you go into partnership with somebody and you set up a limited company, please make sure you have a shareholders agreement. A bit like an LLP and partnership, okay, you need to have agreements in place. With an LLP, you would have a partnership agreement, and with a limited company, you would have a shareholders agreement. Most small business owners who go into partnership and use a limited company do not have a shareholders agreement, and when things go wrong, they aren't very happy bunnies. Something else you need to be aware of: if you use an accountant, it's cheaper to have sole trader or partnership accounts made up. It costs more money to have a limited company because there's more regulation and you have to follow Companies Act, so there are certain things that you have to do. Also bear in mind, if you have a partner, an LLP or limited company, then your information is public on Companies House. So if keeping everything private is a big and sensitive issue for you, then you might just want to have a sole trader or a partnership, but you might end up paying more tax. So that's something that you need to bear in mind. I've kept that pretty brief and I've covered everything that I think you need to know in a very succinct manner. I hope you found that useful. Until next time, bye for now.